Hello, welcome back to Taboo. My name's Katrina and I am your host today. We're back in the studio with Nick, who has been here many, many times. And our special guest today is Matthew Davies from Opes Financial Partners.
Good afternoon. How are you doing?
Good. Well, how can you introduce yourself?
Sure. So I mean, Opes Financial Partners, we're in our 12th year now. We're a debt advisory mortgage brokerage, predominantly supporting ultra-high net worth clients from the UK and overseas that invest in London property. And then aside from that, I guess you've got three separate teams. So we've got an international desk with a number of languages spoken that assist international clients who either live in London but perhaps earn their income overseas and have decided to move their family here, or clients that don't live in the UK but they've invested in the UK just to have a second home or an investment property here. The other side of our business is our domestic markets. That's your sort of Joe Bloggs, any loans from sort of 250,000 up to about 20 million for a UK buyer for his family in their own home and an investment property or a commercial property. And then my team, which I head up as a director, is niche lending. So we do development finance, commercial property, trading businesses, anything that's a little bit quirky, hotels that you can't sort of stumble into your local NatWest or Nationwide and arrange debt on.
Great. Well, today we're going to be talking about debt advisory, and we will kick things off with question number one, which is, what is debt advisory?
So I think a lot of people, if you look at other markets, what you've got to understand with the UK is we've got an incredibly sophisticated network of lenders and infrastructure and lending, which is supported both domestically by UK banks, but international private equity houses and bridging lenders and international lenders. So as a firm, I think we've got a panel of 128 lenders. That doesn't mean necessarily that every client will have access to 128 lenders, because they won't. And to be quite honest, some of them are specialists in particular areas like leisure. We spoke about hotels, property development, finance, and everyone's got their space and their sphere of influence. But so I guess what clients come to us for is, if you think about it in a UK retail mortgage perspective, so Mr. and Mrs. buying a house for themselves, looking for the best rate, if we've got a panel of, say, 90 lenders that do that, they've got a 1 in 90 chance of having the best rate. And we typically are unique, unlike other financial services, where we get remunerated by lenders directly, so we don't have to charge our clients a fee a lot of the time. So our service to the client is essentially free of charge, which is unique compared to other IFA roles like pension advice or investment advice. So there's not necessarily always a fee attached to what we're doing. Sometimes there is in unique circumstances, but it's not every time, which is great for us because it's a great industry to get into, because it means that we can add value to our clients, but also those clients will typically be with us a long time. So one side is the rate, and quite often clients lead with that. But particularly now, if you look at a post-COVID environment, you've got some banks. So you've got some banks where basically their staff are still working from home 3-4 days a week, and it's taking 6, 7, 8 months to get a mortgage application approved. And you've got some banks which are really keen, really hungry, usually smaller challenger banks, a bit like TAB, just a challenger lender, who are a little bit more fluid and can move a lot quickly. So it's not always rates that people come to us for, but it's actually delivery. And we've got the relationships, 11 years in the industry as a firm, but obviously a lot of our guys have been in the industry much longer, so we can guide clients not just on getting the best interest rate or the terms. So for example, they might want interest only, they might want a higher loan to value, they might want something that's fixed for a longer period of time. So everyone's got their own reasons for taking finance, and different things are important to different people. So it's not just rate, it's also the terms, the conditions of the loan, but also the deliverability. Like there are certain banks which I won't mention today, but they've got the best rates in the market. But unfortunately, when you have the best rates in the market, the whole world and his wife applies. And if you've got a call centre where everyone's working from home, you're not going to get any feedback for your mortgage application within 28 days. And if you need to exchange contracts on your dream home in 28 days, it doesn't work, and it puts everyone under a lot of pressure. So
does it also go for the lack of flexibility? The cheaper the rate, the less flexible generally lenders are with that product.
Well,
I know it's true in the specialist market. Are we talking about mortgages or both?
Yeah, exactly. So I think what you're looking at is you've got three things in life. Okay, you've got pricing. Okay, you've got speed. Okay, and you've got sort of the terms basically. And generally, you can only really have two of those. So if you get a very, very low rate, the terms will be very, very rigid, and it probably won't. It might be quite fast. But if you've got one that isn't which is flexible and very, very good pricing, it's not going to be very fast. And that's typically where we are. So we give clients a suite of options, advise them on their own personal needs, and then come back, and they generally come back to us with what their feedback is, et cetera, et cetera. But I would say now more than ever, I would say 80 to 85% mortgages above £300,000 in the UK are done via brokers. And it's because of relationships. You don't want to be in a situation where you're on hold for an hour and a half to a call centre to someone who's done, a 1 week training course and who understands less about what he's doing than you do.
You get a lot of computer says no.
Yeah, computer says no. So what we're selling here, we're selling confidence and deliverability and cash flow, aka pricing, basically.
And you kind of mentioned earlier briefly that kind of it was a mortgage broker. So a debt advisory firm arguably is just the
so
same
there's
as
different terminologies. I would say a mortgage brokerage is someone who typically does small mortgages up to say £5 to £10 million, and then above there it becomes a debt advisory business. And there's a crossover. Where I play is probably loans between 5 million and 50 million. But then we have a great team of guys in the office that do 250,000 up to 5 million. When you get above 50 million, it becomes more sort of investment banker, larger lending house territory, and that is more pure debt advisory, and it's slightly different. And we do occasional transactions in that, but I would say our bread and butter is 5 to 50 million.
And what kind of is it advice? What do you actually do? I've got a deal. You'll take it. Will you structure it? Take it to a lender?
So sometimes it's a bit of a beauty parade, right? So a client will come to us, for example, this morning, I had a client, he's got 27 units in Finchley. He's done a development. He sold a few of them. A couple of them are being assisted living or I think shared ownership, actually. So they have to go off to a housing association, and then he's keeping the remainder of the units. So what's important for him is cash flow, because he wants to pay off his development funder with a long-term buy-to-let or investment mortgage. And so cash flow is key for him, and also being able to obtain the best, the highest loan amount possible, because he's got quite a large mortgage on the property. And what that comes down to is a discussion where maybe a tracker may be a little bit cheaper, but when a lender assesses cash flows and affordability, if it's a 5-year fixed, they know they've got the comfort that the monthly payment is the same for 60 months.
Yep.
And you would expect in 60 months, in 5 years, particularly now, we can have a fair amount of inflation on rents. I think Savills are saying 19 to 20% in London over the next 5 years. That's roughly 4% per annum, but it'll be in peaks and troughs. So that lender knows that at the end of the 5 years, the cash flow is going to be better. The debt, even on an interest-only basis, is going to be relatively low compared to the capital value of the property, because interest rates capital values are expected to go up as well. So you find yourself in a situation where, if you want to get the maximum loan at the moment, quite often lenders will push you down the route of taking a 5-year fixed rate rather than a variable rate, because at the end of the day we all sit here with our crystal balls, but we don't know exactly what interest rates are going to do in the next 5 years. Some people will say, okay, the older generations will say, oh, well, I grew up when interest rates hit 18%. I don't think it's going to go anywhere near that. I mean, the Bank of England's forecasting sort of 2.5% by the end of next year, tailing off back down to 2%. But there's a lot of factors at play here. Unfortunately, we import a lot of our goods, a lot of our oil, our gas, our foods, which is massively affected by the Ukraine war. So we're effectively importing inflation at the moment. A lot of our economics are geared over what the Fed's doing and what the Americans are doing, but they're in a unique position because they produce everything that they use. They produce their own oil and gas for Canada. They produce, the Ohio, and you've got this whole belt of agricultural states in America. So they can control inflation a lot better than we can. So it's a testing time, because what do? You put rates up to control inflation, but then you need people to be able to afford day-to-day living. So it's an interesting time. I think 6 months ago, everyone was jumping on fixed rates. Now fixed rates and swap rates are so high, it's become so expensive that actually some clients are taking a blend. So on a loan, you don't necessarily need to take the whole loan as a fixed rate or the whole loan on a tracker rate. You could say, for example, take half the loan on a tracker rate, which has got no early repayment charges, and half the loan on a 5-year fixed rate, and give yourself a bit of a balance of risk versus reward in terms of pricing.
Can I just jump in? Question. They say property is going to go up, as you just said, property values are going to go up. If rates are going up, which means people can borrow less because as a multiple against the income on their income, right, they'll be able to support a lesser mortgage. That means there'll be less people to buy property, hence less demand. Surely prices will start to come down a little bit.
No, because look, I can understand why you would say that if you look to like the next 3 months. So what's happening right now is you're going to Tesco's, you're going to Waitrose, and you're finding that your average what cost £15 for the family dinner last week or 3 months ago now costs £22 or £30 or whatever it might be. So yes, there is inflation, but what we've also got to understand historically is there'll be wage inflation. So everything goes up. We don't have a situation where wage doesn't go up and rent doesn't go up and property prices do go up. They all generally follow each other.
Yeah.
So they don't always, they're not in tandem. So I think what you'll find is that the wages will go up, but they won't necessarily go up in the next, in line with interest rates. But in 5 years' time, people will be earning 20% more than they did now, and house prices will be 20% more than they are now, and salaries will be, and rents and everything else will follow that trend, because that's essentially how it works. And what is the inflation now is all the stimulus packages, aside from the Ukraine war, oil prices, aside from food prices, the essential fact of the matter is because of the stimulus packages from the United States, the European Union, the UK, and a lot of other large economies across the world, if the world economy is a balloon, there's 20% more air in it, and it's got to go somewhere. So gradually, it's got to go onto everything. What is in the reason rates being put up is because they want to control how slowly things go up, because they don't want to be in a situation where if you earn £20,000 this month, or sorry, no, let's change that, because that's they don't want to be in a situation where if you earn £50,000 a year this year and everything goes up. They want to be in a situation where everything goes up, but you're earning £60,000, so you can cover that and you can deal with that. I think the unique thing in the mortgage market is when I started out as a broker, base rate was crept up towards me passing my exams to 5.75%. And people, if you look at like the way the Americans or Canadians or even the Caribbean, how they underwrite credit for a standard mortgage, they don't want your monthly payments to be more than 28 to 30% of your cash flow. So if you earn £10,000 a month or $10,000 a month, they don't want your mortgage payment to be more than £3,000 a month. Essentially, what people found then was, when I started doing mortgages, is that you assumed that what your take-home pay was, a third of that went on your mortgage, which is about right. When we had the credit crunch and interest rates went down, base rate went down to 0.5%, suddenly it was like, right, okay, well, I've got a lot more cash flow. Particularly buy-to-let investors had a hell of a lot more cash flow. And that was a bit artificial. That wasn't something which was normal for the trend of the market. And it's lasted for 5 or 6 years. But unfortunately, interest rates have gone up, but they've only gone up to people spending 30% of their monthly budget on their mortgage, which was always the case before. Unfortunately, it doesn't feel as good because everyone's got used to having slightly more salubrious lifestyles, because they didn't have to budget 30% of their monthly cash flow. They were doing 10 or 15%. But, that's it. The other thing that will happen typically when interest rates, so the PRA, which is one of the regulators, has come out and taken the pressure off forcing everyone on repayment mortgages on short terms. So they're now offering more flexible, typically when you go into a higher interest rate environment, you have more interest-only mortgages and you have more deferred interest mortgages when interest rates go very, very high. So what you'll find is that when interest rates are high and for first-time buyers, typically they'll get more interest-only lending. For example, they might get the first 75% of the purchase price on an interest-only mortgage, and then the next 10% up to 85% or up to 90% will be on a repayment mortgage. And it's just because in the early years, particularly if you're a graduate, for example, which I think this podcast is aimed at, you might have a slightly lower salary. And if you look at, say, for example, like Scottish Widows, they have a young professionals product. So if you're an accountant, if you're a lawyer, if you're a doctor, if you're a teacher, they know that obviously your starting point is relatively modest at, say, £25,000 a year to £30,000 as a graduate. But within 5 years, that will go up quite substantially. So what you'll find is for higher loan-to-value mortgages now, the cash flow isn't there to force everyone onto a 25-year repayment mortgage. So there'll be a part and parts. You'll have part of the loan on interest only, part of the loan on repayment. And then gradually over time, as if you've got 3 tangibles, your income will go up over time because of inflation, and you'll get promoted and you'll become more senior. Your property value will go up more. So your loan to value will come down, which will be more attractive interest rates. But the only thing that stays the same is your mortgage amount. So if you can stretch yourself to buy your perfect place now, your position should become more and more affordable as time goes on. So what that means is typically younger people will have more interest-only mortgages, and then later will take more and more on the debt, which we call staircasing, or to a certain extent, on a repayment basis.
Is that sort of a thing? Is that sort of thing something you would advise on, or you would be able to talk through someone who, well, maybe not for someone, but like someone who was investing into a property, and you were like, "Look, this is how it works." Is that something you'd sit down
absolutely.
and go through with them?
At the forefront of everyone's mind is, quite honestly, for most people, they see a property that they like and they think, right, how much is it going to cost me a month to live there? The good news is rents, are, even in London where yields are lower, are usually substantially higher, 20, 30, 40% higher than what your monthly payment is on your first mortgage. So that's reassuring, although they may need some money for furnishings and things like that. But essentially, yes. So cash flow's the first driver, and then it's like, right, well, I want to get this debt down and be in a position that, why do I want to get the debt down? Probably for two things. One, because they want to build up the equity in their home so that they can sell and move to they might start in a flat and move to a house when they have a family, but also because they want to get to retirement age and don't want to have a mortgage when they retire. We would advise on that for cash flow, but also for a buy-to-let investor, it's the same. So a client may want a particular return on equity on his money, and also the way the buy-to-let market works at the moment is most people will buy buy-to-let investment properties in a limited company. When you buy property in a limited company, you can offset 100% of the mortgage interest against your rents, which you can't do in your personal name. So most investors, particularly large, what we would call professional investors, will invest in a limited company. So for them, it's about cash flow. Now, if you are paying large swathes of money off your mortgage each month by taking a repayment buy-to-let mortgage, one, it's going to mean it's going to be stress tested by the lender, so they might lend you a lower loan to value, so you need more equity in the first place. But it's also going to mean that you're going to attract a tax charge on what you pay off. So what you'll find is, for professional investors, the game is not buying one really nice buy-to-let and paying off the mortgage as quickly as possible, but buying one buy-to-let, letting the rent build up in the account, making money elsewhere, topping it up, maybe remortgaging it when it's gone up in value, and basically growing the portfolio, so buying more and more and more properties. Because if you've got 5 properties worth £500,000 each at 2.5 million, okay, and the market goes up 4%, okay, you've made £100,000 in capital growth, okay. If you've got one property and it goes up 4% and it's worth £500,000, you've made £20,000. So you've lost £80,000 essentially. But also, there's always a difference between the rental yield and what the mortgage is. Even now, when interest rates are creeping up slightly, so you're always going to have a little bit of headroom and a little bit of profit, which is why we all do it really. So, and when interest rates were lower, but even if you look at pensions and investments, for me, if you've got a couple of buy-to-lets in a limited company, and you grow that over time, every 5 years you remortgage, take out some equity, you've built it up some rental income, and then you buy another property. That's a fantastic, if it's in a limited company, that's almost like a pension for you really, but you're going to have income, capital growth, and flexibility about how you invest and when you take money out, etc., etc. So I think it's a good solution.
And if we go on to kind of question number 2, which is, does a debt advisor cover the whole market? Now, what kind of service, we briefly touched on it before, but what are the different types of services you offer? I guess, how much do you cover? We've obviously spoken about...
So I would say, debt advisory covers not just real estate, okay? So, for example, if you imagine like private marine finance, yacht finance, or private jet finance, private aviation finance, for example, essentially what you've got is you've got an asset and you've got an individual or a corporate entity behind it. And a lender is assessing the asset and the individual simultaneously. And for long-term mortgages, the individual is typically more important than the asset. But on other transactions like short-term lending for yourselves, the asset's key because it's a shorter-term transaction, and you're not going to have a 25-year profile of the property going up in value and the loan coming down by a repayment mortgage or an interest-only mortgage, and the loan to value gradually decreasing and making you reducing your risk basically. So we focus on the real estate. We have done for clients from time to time. We have funded private assets like in aviation and marine. Overseas property, for example, I do quite a lot of lending in the south of France, and Spain's particularly popular with Brits, the Caribbean. And there are nuances and differences between the way that banks underwrite loans, but typically they look at the individual, they have a set of criteria, and then they look at the property and they have a set of criteria. And then it comes down to which bank's criteria on both of those areas is the best fit for the client, basically, and gets them what they want. But yeah, I mean, we wouldn't be doing debt advisory on, for example, a dam in Africa or a factory in China.
But could someone essentially offer that?
Yeah, well, people do offer that, of course, like infrastructure finance and everything else. Yeah, I mean, in everything, all aspects of life, there's debt. You know, if you're importing, you know, if you take a freighter and you're importing bananas from Guatemala and selling them to Latvia, and then in Latvia you're picking up frozen chickens to take back to Guatemala, or whatever it might be, quite often the people that behind that trade, they will take a letter of credit, they'll take some sort of trade finance. The boat will have finance. The people that live on the boat will have mortgages. It's everywhere where we look, basically. And that's what I love about mortgages. Is there's a little bit of confidence in being a mortgage broker or a debt advisor, because I could get on a train full of people or walk into a room full of people and most of the people in there will have a loan. So, you know, whatever happens, my phone will ring. You know, and we have to react to market conditions, but it's not an issue. When you look at some of these more niche spaces, they get hugely affected by their own market conditions. So you might have a situation like I've got a client who's a cocoa trader. He's, you know, basically deals with the Ivory Coast, cocoa, trading it to chocolatiers across the world and people like Nestle and everything else. Now, if they have a drought one year, or they have a particular fungal infection that's going around the trees, or an insect or whatever it might be, it can hugely affect the market. And the issue is the people that provide the debt in that market are limited. So it can have huge ramifications when, in reality, in the UK, if one bank won't do something, there'll probably be another bank that will. So if you've had a situation where you are buying a property but you've missed a few payments for whatever reason, or you've been in a situation where you're buying a property with subsidence, or you're buying a property which is land with planning permission but it doesn't have a property on it. Yes, Joe Blogg's bank might not do it, but another bank will. And quite often we're taking clients on a journey where we're saying, well, you might have a slightly higher interest rate, but then you're making a massive return, and there's an asset management play, which would be like a tab transaction, and then the long-term loan comes in later.
And what is the most kind of unusual case you've come across then, or you've dealt with? I mean, the cacao one's quite cool, but I like the idea of chocolate trading. But that wasn't something I was doing day to day. I mean, we get clients from lots of quirky and interesting jurisdictions, and sometimes we'll do a loan across different borders. So we might have a property in France, a property in London, you know, a vineyard in Spain, and a private bank will lend against all of those assets. There's several, you know, he earns in one currency, he's borrowing in different currencies, etc., etc. I think the main thing to take away from debt advisory is we're coming on to this later with the questions, I think, but it's not necessarily about, I wouldn't say that being a debt advisor, mortgage broker, it's all about relationships, communication skills, and being a likeable, nice person, essentially. It's not, yes, it is technical in a way, but standard mortgage broking, where you'll start out, it's not technical. It's about dealing with people and getting on with people. And if you're a people person, you can do well as being a mortgage broker. If you're insular and you know, wrap yourself up with regulation and you struggle with you know, communication, this probably isn't the career for you, I would say. And I would also say that, to a certain extent, mortgage broking and debt advisory is quite unique in that in the office, the job can be quite mundane. It's paperwork, basically. But it's got a huge amount of pressure, because when you start out as a mortgage broker doing £250,000 mortgages, you're still getting people that have seen their dream house, that are desperate, with an estate agent breathing down their neck saying, you've got to buy this property now, you need to exchange next week, etc., etc. And they're under pressure, and they inevitably pass that pressure on to you. So it can be very, very stressful. And, you know, like a lot of jobs, you know, there's a burnout rate and everything else.
And there's ways of managing that stress. But yeah, it can be. What I would say is people looking at the industry in a view to joining it, you should understand that it's a lifestyle as well as a job. You can't really go on holiday for 2.5 weeks like you could do with another job and just switch off, because these people have got their lives, their finances, their mortgage is the biggest financial investment. It's the biggest debt they'll ever take out for most people. So, you know, you need to be accountable at all times, basically. And with clients all over the world, you know, my wife will tell you, you know, we go on holiday. I have 1 to 2 hours a day where I'm on the phone. But the good news is we get to go on holiday to nice places. So, you know.
Well, that does lead me on to question number 3, which is, what is the difference between a broker and a debt advisor?
I think it's terminology, to be quite honest. We're all doing the same thing. It's all relationships with lenders and structuring things. A debt advisor typically deals with larger loans, and it's more of an Americanism. It's a bit like we would talk about property, or if you have a flat, it's generally cheaper than an apartment. If you have, you know, if you have a loan, it's generally lower than a mortgage, and debt is probably more than you. When you talk about debt in terminology, that's more than £10 million in mortgage talk.
I would also say debt advisor actually charge a less percentage on your fees because of the size of the transaction.
Yeah.
So you're actually, although your fees are in theory bigger due to the size of the loan, actually you're probably getting whittled down by that client who are generally larger, more institutional, don't pay huge fees, but the percentage of the deal you're doing should be relatively large.
Yeah, exactly. They're bigger deals. They're more sophisticated guys, and they understand the market a lot better. So they're not going to be. It's not as profitable per pound you lend. So if you look at the retail mortgage market, say for example, you guys came in and you were buying a property for £600,000 and you were borrowing £500,000. Every lender, which is why the UK market's sophisticated and trustworthy and regulated, typically will pay you 0.35% of what you borrow, okay? So you're going to earn £1,750 or whatever it is as a mortgage broker for arranging that loan. And then you might arrange some life insurance, you might do the general insurance on top of that. But that's typically how it works. Buy-to-lets, you earn 0.5%. More specialist lending, you would earn maybe 1%, sometimes a little bit more. And then as you move up the scale in terms of loan sizes, you know, the end of the day is people are comparing, they know the market, they're looking for a slightly more sophisticated package, and therefore your earnings as a percentage of the loan amount will be lower. But they're going to be repeat clients that you have a relationship with, that you do multiple transactions with.
But they'd also expect you, I suppose, for those larger ones, and I was in that market for a period of time, they would expect you to potentially put a full pack and suite of documents together to present to the lender. They want you to understand the transaction as if it were their own. Also, when it comes to loan documentation, they expect you, I believe that, you know, when you get in the 50 million plus, that they want you to review all the loan documentation, facility agreements, or debenture, all the charges, everything else, and then go back to them probably with comments, not just, oh, I've got your deal here.
Yeah.
Let me know if you want to do it or not.
If someone's borrowing £20 million, you can't just ram it down their throat and say, this is a great deal, take it or leave it. Not that we would do that anyway. I mean, that's not how we would work. But it's a slightly different, it's not solutions, it's advice. So it's more around, and there's more discussion around the terminology of things like personal guarantees, corporate guarantees, debentures, how the loan's structured. And because the structures are more complex
Make
as well,
whole provisions, all these extra
and also tax. But when loans get larger, and you get more international money involved, tax becomes a big word, because suddenly what you save on one arm, you might trigger a cost on another.
Do you offer tax advice in FX?
No,
in your office?
But we work with people that do, and to be quite honest, we can give an overview of what's happening in the market and what other clients are doing.
Fine.
And how is this, something you would work with the lender with as well as the borrower to kind of try and figure out all these solutions?
Yeah, correct. So quite often, if you've got a sophisticated borrower, he'll come to you and say, right, I've had these terms, but I'm looking for something with this, this and this. And then we'll say, okay, well, we can structure it like, we can do it like this. I had a transaction last week, which was a property portfolio. A guy is buying out another business partner, essentially. He said, I don't want to give personal guarantees. I need the loan lending against search indemnity insurance, so he doesn't have time, because he needs to transact quickly, to apply to the council for all the searches. There was some outstanding planning issues on one of the properties. There was a myriad of issues, basically. And then basically, so we'll say, okay, well, this lender, yes, is cheaper, but this lender will do it, and will transact with search indemnity and they'll do a desktop valuation because the loan to value is low, and we can do an automated valuation model, which is basically a bit like when you go on Zoopla and you estimate what the value of the property is. If the loan to value is low enough, then lenders can work off that and you can get a deal done quickly. So, these are all factors that are discussed.
Great. Well, I'll go on to question number 4, which is how did you get into this specialist lending market?
So I went skiing with my friend Alistair and his dad and their family, and his dad's best friend was a chap called Steve Smith, who's still a good chap. He's a little bit older than me, so he's moved down to Cornwall now, but he's still active in mortgages. And so we went skiing together, and I think he sort of thought we got on quite well, and I let him beat me at pool, and then essentially he said, "Oh, I was waiting to go to university. I was on a gap year," and he said to me, "Right, do you want to come and work in the office?" It was £10 an hour. I was like, great. It was cash in hand to start with. I said, I'll work 50 hours a week. I was earning £500 a week, and I was 18. I thought, this is great. And then, I guess my dream was always to sort of, growing up, was to go in the Navy or do a government job or something like that. And quite patriotic. But then I've realised that actually my skill sets, as you can see from the size of me, is probably not running around in a field shooting an assault rifle, but actually talking to people and not having to get up at 5 a.m. And et cetera. And I guess by nature I'm an entrepreneur and I'm a communicator, so I've got those skill sets. And actually I fell into this job and loved it from the get-go. And I was lucky. I joined a firm called Cobalt Capital, and they were an established firm that were really going gangbusters at the time. And I got a lot of exposure to people that I'd never met before, and I saw a whole world of different characters and personalities, and it was great, but great fun, great banter. It was a great community to be part of, and I thrived in it and I've enjoyed it. And nobody wakes up when they're 5 years old and goes, "No, I don't want to be an astronaut, Dad. I'd like to be a mortgage broker or a debt advisor. I want to do debt advisory work." But I enjoy dealing with all the different characters, the international. There's quite a lot of travel involved, and it's a great lifestyle, and you feel valued because you're delivering for your clients. Yes, you feel stressed when you have to find new solutions, but when you get things done, you get deals done. Like me and Nick had a deal complete last week, and it'd been taking a bit of time. There were a number of moving parts. So, it's a good feeling. You can look at yourself in the mirror because not every day I'm coming in and doing the same thing. I'm doing something different, and you're problem solving, you're dealing with challenges, and I love it. And to be quite honest, maybe I'm a bit biased, but I don't understand why people wouldn't. But there are people that wouldn't.
And now I guess...
Hold on. The main reason is they can't network like you and meet the right clients.
Okay,
I honestly believe that is one of the reasons. If you haven't got interesting deals, interesting clients, and they're not loyal to you through your service, and they're not keep coming back, it can be a hard slog if you're constantly looking for the next client and no one keep coming back.
I remember when I started out, I was doing retail mortgages, and I always used to think, right, well, if I go and see a client at his house, he's going to do a deal with me because I've gone to see him, and I don't want to say I've emotionally blackmailed him, but, he's invested in me, I've invested in him.
Yeah.
Met his wife, met his kids. But when I transitioned into doing niche advice, so when I started doing development finance, quirky things, a lot of the deals that go around, and it takes a lot of experience to understand what's good and what's not, and who's good and who's not.
Yep.
And fortunately, the relationships I've got, particularly with lenders, is I bring a client, generally they've got their head screwed on, it's a good transaction, and everyone works towards it and is motivated to deliver it. It's not always like that, there's always different nuances and different things going on. But look, it's cool. It takes time and experience. I don't think you could come out of university and do my job, but there's probably only 5 people in London that do my level of business and my job. But you can definitely get there, and you can get there by just being a nice guy. You've got 2 ears, 1 mouth, which is another thing Steve said to me because I keep talking all the time.
We hadn't noticed.
Yeah. So, but you've brought me here to talk. So
it's different.
Fair. It's different. Yeah.
You're on a podcast, all.
Yeah. Exactly. But yeah, So yes, it's relation. A lot of the business, the estate agents, the introducers we've had over time, they've got better and better. We're into bigger accounts. We're acting for bigger and more substantial institutions, and we've got more established clients. And also over time, if you start out as a mortgage broker, and you, as you know, we're not charging a large fee for advice. So those clients are going to be with you, providing you provide a good service, and that just basically means picking up the phone, being contactable, and being driven, and being ferocious and vicious with lenders to get things done.
Yeah,
it's let alone relationships with lawyers and accountants and valuers. But
So
yeah, so yeah, that's what I. That's what
yeah,
I
it's
put
interesting
down.
you say that, because I was having a conversation in the office the other day, and I was saying that the biggest thing I struggle with sometimes with new people coming into my team, or just generally, is it's consistency.
Yeah.
Every day, over a long period of time, with hard work. Right? I feel like the people that have done well in our industry are the people that have stayed on our industry, haven't flip-flopped between industries, don't come in, don't dip out. They've got they're on the pulse with lenders. If you're a debt advisor, broker, and likewise as a lender, you don't want to see a sales guy who's been at 5 different lenders over the last 5 years.
Yeah, and we get them all the time, and they contact us. Oh, I want to come in and see you, and it's like, look, I'm not being rude, okay, but we've got a decent business here. I don't want to be in a situation where I get my whole sales floor into our meeting room to chat to a guy that's not delivered at 6 of the banks he's worked at.
Yeah.
And sometimes you just got to be upfront and honest and not be rude, but just say, look, unfortunately, we've got a relationship. And the easiest way is just to say we're dealing with someone else within your...
Well, you're always burning bridges, right?
Yeah.
Because you keep saying, oh, here we go, another new set of criteria. It's not even a new set of criteria for the lender you're at, who maybe you've got a new product. You're literally coming in with another new lender. So what, we're going to invest back into you again for the third, fourth time over the last 5 years. And then what, you're going to stay there? I mean, you can get a reputation of being moving. Now, there are always good reasons to move. Sometimes, you've overperformed, someone's come in, someone's brought you in, a bigger, better firm, great. But I think, and maybe it's particularly with the younger people as well, we are in a now society. If I can't do it now, if I haven't done it within 6 months, it's not for me, or, these people aren't providing me what I need to do my best. I think just there are still the few names around in our industry who stayed at the top for a long time because they've stayed doing what they've done through hard graft.
I mean, I've been at the same firm for 11 years, but
yeah, but it's yours.
Yes, but look, I agree with you. You do get guys that flit around for different reasons, and banks change their criteria. And, I had lunch with a banker the other day, and some of these banks are large international entities. So if you imagine, lenders are a bit like boats or ships. So if you're, say, for example, a bank like Barclays, you're huge, okay, and you have a huge market share, and you're a huge boat. So for you to change anything takes a long time, basically. Yep. And people get frustrated by that because smaller challenger lenders, who typically will pay more money anyway, can just zip in and change their criteria to attract the market, basically. And so I can understand that for some people, sitting down, it's like treading water, basically. And they want to move, and they might have a change in their circumstances, and they might move to a different location, whatever it might be. So look, people move around the industry all the time, but over time you realise who's a good egg, who's not. Yeah. And they're not generally bad eggs. They're just less motivated. I think that's the thing. There's a lot of people. If you're driven and you're hungry, then you're going to do well. And going back to burning bridges, I mean, I started Opes when I was about 19, 20, I think maybe 21, and my business partner's 10 years older than me, and I was, a gobby, jumped up, aggressive guy because I was desperate to do deals and I wanted to tell everyone about how great we were, and I did to a certain extent go round and burn a few bridges, but then luckily I had Masood, my business partner, who would then go and build them for me behind me, sort of the turmoil.
Sounds like me and Duncan, to be fair.
Yeah. So look, it happens. And,
so he was the gobby one.
Yeah. But look, it happens all the time, and but and the weird thing is 1 year, one lender, you think, oh, they're rubbish, they're not doing anything exciting, their rates are too expensive. And then suddenly, bang, they're in the market, they've got great rates, they're flexible, they're open for business. And so you can never, experience now has taught me that I don't need to, if something's not going to work, it's easier to say, yep, very nice, thank you very much, and just keep in touch with them. And also, quite often, a lot of the market intelligence I get is not necessarily, although we have a floor full of people, and we have, there's different things that we subscribe to for lending news and everything else, but quite often it's speaking with people, but it's people like valuers and lawyers who act for banks, and it's like, who are you busy with at the moment, what are you working on, and they'll tell you and you'll go, okay, fine, and
you
then
see a bit of trend.
Yeah, you get a trend, and quite often, I mean, I had a loan complete for 15 million on Friday with a Middle Eastern bank for a North London family that are a big property family. And so they had another broker who couldn't deliver. I've stepped in, delivered, and suddenly the banker says to me, "Oh, that guy's broker is now contacting me with inquiries." But the old me used to think, oh, I'm really angry about that. That's my my intellectual intelligence. That's my information. But the truth of the matter is, let's be honest, we've all done it.
Of course.
Okay? When I was younger, I'd lose deals, and I'd go, oh, where's he gone? And then the next deal would come, and then I'd be like, oh, I know the perfect lender for you. And I'd feel like, I was.
That's how we all grow.
Proud as punch.
You've got to learn at some point. Sometimes he learned through a failure.
Yeah, and you do. And human nature is basically the same in mortgage broking. If you're a nice guy, you'll do well. If you're driven, you'll do well. It's not rocket science.
So for new people starting out, you came in and just met a guy and got on with him and went to his company.
I started right at the bottom. I did admin. They had a huge transaction. The old Sarson's Vinegar Works, which is called Malting's Place in Tower Bridge, was my first transaction, and I think there were like 300, 400 flats in there. I was just doing the admin for a broker, and basically it was just a case of 300 flats, 300 mortgages. Sometimes you'd have one lender over the whole lot, but if you want a higher loan to value, sometimes it makes sense to break it down, or break it down because you want the best fixed rate with that lender, the best tracker with that lender, the best loan to value with that, but then a cheaper rate, a lower loan to value with that, and you can you can merge the criteria, you can merge the rate. So that was my first job, and I just every day
Did you ever had to kind of do any qualifications over your time? What, if you're starting out in the industry, what kind of things are you looking out for? What should you do? So
it's changed now because we have this IFS, which is the Institute of Financial Services, and they have their own, they call it the IFS School of Finance. I don't even know. I mean, it's I see guys in the office doing it, but it's not something that I do. I did CMAP, which is Certificate of Mortgage Advice and Planning, and you've got three areas, three modules essentially. So you've got sort of the regulatory side, so that's all your data protection, making sure that financial crime, that you understand and you can highlight and see potential issues and problems. They don't come up regularly, but it's about understanding how to behave correctly and compliantly and deal with people correctly. With regards to the laws and the Financial Services and Marketing Act, you shouldn't be calling people at 9 p.m. on a Sunday saying, what rate are you on? Not that I would, but anyway. Section 2 is more the mortgage module, and actually the Section 1 is your sort of foundation for pensions for lots of financial sectors, not just mortgages. Then, so Section 2 for us or CMAP 2 is a mortgage focused. So that's more learning about all of the terminology and what happens in different regulation, but purely on mortgage and mortgage advice and what the mortgage advice process is. So when you take a client, you assess their needs, you highlight to them what their needs are, you explain, you give reasons why, you illustrate to them why this is a good product for them, but you give them other options. For example, if they take an interest-only mortgage, they need to understand that they can have a big loan when they're 65 or 70 or whatever it might be, and therefore if you take a repayment mortgage, it might only be £300 more a month, but that's not going to be there, or whatever it might be. So that's a big part of it. And then Section 3 is almost like case studies. So you've got your regulatory knowledge in 1, you've got your mortgage-related knowledge in 2. I always say, and this may be the wrong way around to do it, but always do 2 first, because if you're starting out in the industry, that's the one where you learn something, you read something, you go in the office and you see someone doing it, and you learn about it, and you get experienced in it. Section 1, remembering when a date of a particular act is, it's a bit like doing algebra at school. You pass the test, you understand the reasons why things happen and what needs to be done correctly, and you sit an annual exam and a competency exam, which you do with your mortgage network, or if you're directly authorised like us, we have a company that we do it with. But essentially, you get past the regulatory stage, and then it comes down to the advice, and that's more interesting for you because that's the crux, that's the bare bones of the deal that you're doing and the job you're doing. So, and then Section 3 is advice in action. So they would say, Mr. Khan and his wife are buying a property for this. They have this situation. They want this loan to value. They want a repayment. And you don't actually have to get it right in terms of, you don't need to log on to and say, well, the best rate in the market happens to be Clydesdale Bank for you because you're self-employed and you need someone that goes off net profits, not salary and dividends. It's not that advanced, but they want to see your thought process. They want to see that you're logically looking at this and you're not overlooking things. You're looking at the rate. You're looking at interest only, repayment, you're looking at the loan to value, you're looking at repayment strategies, you're looking at what visa status they've got, so you're not going to submit applications to lenders that can constantly get declined, basically, because it doesn't fit their criteria. And so that's it. Now, that process with starting in the industry should take you 12 months. Then you go on to a process of basically being signed off as you're a broker under yourself and appearing on the FCA register. And that is a further 6 months. So that's when you start being given smaller cases. You're monitored. Myself or my business partner might come into the first interview, or it will usually be like one of our clients' children or one of our clients, a smaller loan, not very complicated. And you go through the advice process, and you get what's known as competent advisor status, basically CAS. CAS sign-off is what it is. And that's when you start earning decent money. So and that's 18 months down the road. 18 months to me now is like, that's when I could book my next holiday.
Yeah, it's a flash in the pan.
Yeah, but when you're at 19, 20, you're like, oh, God, I want to earn good money now. Look at these guys, I'm better than him, blah, blah, blah.
Yeah.
Why is he pushing in front of me at the photocopier? That's it, because you're driven, you're excited. So, but yeah, you've just got to sit it out. And to some people, they're more naturally relaxed. For me, I found it really stressful because I was so hungry, basically.
Yeah.
But you get through that process and then gradually move on. What I would say is where I see our brokers go from, zero to hero or do very, very well, is they're the ones that ask loads of questions and never be scared to ask questions.
We always say that in the office.
Yeah.
But you get guys that sit at their desk and they want to prove, and we've all been there. They want to prove that they're the great broker and they're, you're not a Jedi yet, and they'll make mistakes because they'll miss something, and they could have just asked, but they want to prove themselves. But the end of the day is, we're not asking you to prove yourself. We're asking you to sit in the chair, be a nice person, and turn up on time and stay focused.
Can I just jump in?
Yeah.
How does a broker make the transition from what I call more tick box mortgage broking to the more sexier debt advisory brokerage side of the alternatives or specialist lending market?
So I think basically what it comes down to for most people is they'll start off as a vanilla mortgage broker and they'll get leads, and from that they'll suddenly. So say for example I did a mortgage for 4 people buying a buy-to-let mortgage each, and there's a process. Like clients might buy their first house, then they might buy a buy-to-let.
Yep.
Then once they buy a buy-to-let, they might watch Homes Under the Hammer, and they might buy an unmodernised building to convert into 4 apartments, which would be a tab deal, for example. And then after that, they might start looking at commercial. Now, most people never get up to that commercial and start saying, okay, I've got an aircraft hanging here on a lease to DHL here. Isn't it great? But what will happen is you'll start off vanilla, and then through your network, because although you're employed, you have your own little book of clients, you look after your own relationships, and to be honest, the only way of doing things. So if you look at some of my brokers, they will have they almost have clients that sort of fit their personality, if that makes sense. So you'll have a more sort of structured guy who will have loads of professional clients like lawyers and actuaries, and then you might have a client who's a little bit more sort of ad hoc like me, who would be dealing with property developers or whatever it might be. So it's horses for courses, and we encourage people, particularly Opes, to go into a direction which they're excited about. So, for example, I remember when we were first starting out, we started doing a bit of Nigerian business. So then we started hitting all up the Nigerian banks in London, the law firms that specialise in, cross-border transactions with Nigeria, because it was interesting, because they were interesting guys. They were doing large transactions. They were particularly active because the oil price was high, the Nigerian naira was high, and the pound was relatively weak against the naira, so it was a great time to buy in London, and a lot of them buying sort of around South Kent, basically. So there's an example, and I had a whole sort of spate of 3 months where all my business development was in that area, and then you'll find something else that you're interested in, you'll move into something else, and it's an organic process essentially. But essentially you start out being given leads, and then you start to receive leads, and when you start to receive leads, they will become much more varied and much more technical on certain things, and that's when the guys will knock on the door, come in and see me and say, oh, one of the young chaps, Ed, who's been with us a year and a bit, he came in, he said, oh, I've got a cinema, or I think it was, or something like in Warsaw, which we're doing with you, and he's converting it to a 14-room HMO. So great income, great yield, great asset, and you just give them some advice, you explain more the rationale about how lenders underwrite things. It's not a tick box for saying. But at the end of the day, he's got that foundation, he's got those skills now, he's been with us for nearly 18 months. So, we'll give him the support and he'll do that. And then from that, he'll probably do another deal for the client, and then gradually he'll get more varied in the business.
And that's where the relationship play comes in.
Relationship and also it's the more niche lending, the more the income is typically for as a broker. So lots of brokers are more interested in it because it's more varied, it's more problem solving, it's more challenging, and when something's more challenging, it's more rewarding. So it's a bit like if you went and did the park run 5K or you did the London Marathon. I'd probably struggle to do either, but I'd struggle to run a bath at the moment. But if I did either, I think if I did the marathon, the sense of satisfaction would be greater because I've accomplished something that less people could do.
Yeah.
And I think that's where the niche lending is you can go home to your missus and go, it's a bit like, you go home to your missus and go, oh yes, well I've just done a portfolio of NCP car parks with a Thai restaurant on the roof terrace in Guildford, and then as a kicker we're doing a development of 11 apartments or something like that.
I would love to see a Thai restaurant on the roof terrace of an NCP
Well, there is one, and it's very nice. I can't remember what it's called, but it's in Guildford.
I'm going to quickly move on to our final question, which is question number 5. How's the lending market changed in the past decade, and where do you see it going?
Okay, so I would say in the last decade, historically, we've gone from people just going down to the high street, into their branch, dealing with the same bank manager that they've dealt with for the rest of their life, to a more sophisticated, more online market. Mm-hmm. And there's a lot more lenders than there used to be. And there's a lot more international money. You've got people like, Goldman Sachs, who had a company, I think it was Rooftop Mortgages, and lots of banks who've entered the market from overseas to make the market as sophisticated as it is. I would say the UK real estate market, when I look at, say, lending in France and the criteria of all the lenders there, or in Asia, or in the Caribbean, I would say America and the UK, I guess you can guide a market by what loan to value is available, which means how liquid it is, and how many people are within it. So liquidity is made up from how quickly you can sell an asset, but also how many people will lend on it as well. So if you have to change lenders, you can. So I think we're quite unique. I think it's probably us in the United States, basically, I would say have the most sophisticated mortgage markets in the world. And what we have seen is lots more lenders and more lenders becoming, because you've got lots of lenders, you've got more lenders specialises in different things. So that's, I guess, makes the job more challenging but yet rewarding for mortgage brokers. But it also makes it better for a client because the more choice you have, the better return you're going to get. The better outcome you're going to get because there's always going to be someone who's going to do something a bit better. If you stay your whole life with one bank for, let's just say one building society for 25 years and you change your mortgage every 2 or every 5 years, you will be worse off financially than if you have a mortgage broker who changes it every 2 or 5 years, because he might say, okay, well, we're doing a product transfer, you're staying with the same lender because they've got great rates this time. But then, what do banks do when they get to, they have a loan book. A bank has a loan book, or a building society has a loan book. And with that loan book, they have to fill it up, but not overfill it, because they've only got a certain amount of capital to lend. So if you're in a situation where, for example, you're a small building society and you've only got 5 staff members in your mortgage team and you only lend £40 million per year and you lend 20 million in 1 month, you don't want any more business for the next 11 months. So you'll put your rates up to stop people applying. But there'll always be people loyal to that building society that will apply for that rate anyway, because it's what they've always done and it's what their parents have done. So that's why I'm saying, by you moving lenders from time to time, you are in a situation where you'll end up paying less mortgage interest over your mortgage term. And also you can take advantage of better criteria.
Well, it was and then I guess, where do you see the market going? What trends do you see?
Right. So, I mean, I think a lot of people we're quite unique in the mortgage market, where it's not like credit cards and everyone looks for the best rate on Money Supermarket, because we're selling confidence as well as a solution. And the truth of the matter is, if you apply online, it just goes into an abyss, and you've got no control over who's looking at it, and you don't understand the criteria of the bank, of which could massive hugely. So if you've got a self-employed person who, for example, has a successful business and his profits of his business are £200,000 a year, and that business is split between him and his wife, he might not take all of the profits out of his business every year because he'll pay 45% tax. So he might leave some of his money in his business and then buy properties in his business, or put money in pensions or something like that. So a lot of lenders will just give you a multiple of 5 times or 4.5 times, or an affordability test on what you take out of the company. But of course, you could take more if you wanted to. So some banks will look at the business and go, actually, he's got the capability to take more, so we can put that into his affordability and lend him a lot more money. So this is where lenders have got completely different changing criteria, basically. One thing that I think is also important is term. So there's a lot of lenders out there, apart from obviously in the specialist where you're developing, you're asset managing, you're going for planning permission, you're enhancing an asset and you need a bridging loan or a short-term loan. A lot of people overlook a mortgage term and the lender that they're borrowing off. So if you borrow off a small building society who puts really low rates to fill their loan book up, but then normally has very high rates, and then you get to the end of the 3 years and you can't refinance because, for example, your wife's on maternity leave and she's earning less money, you have to stay with that bank, right? So what if we see a client who's, I don't know, of an age of they've just got married and they're trying for a family or something, that's a huge discussion to have, because you say, well, if you're with Nationwide or one of these lenders which have huge market share, their rates might always be the best, but they always can be there or thereabouts because they've got to keep market share. And also, if you're self-employed, you don't want a mortgage with, some banks will give you a 3 or a 5 year term, and then in 3 or 5 years term, you're an entrepreneur, you've sold a business, so then the income on your tax returns isn't there anymore, but you've got a lot of cash. They can't factor that in because they just look at affordability, they look at monthly cash flow. So term is really important. If I get a self-employed client, and I look at a private bank, so for example, Coutts could give you a 40-year term, or you could look at, say, for example, another private bank will give you a 5-year term or a 3-year term, for example. Do you really want to be a situation that two years after you've drawn down on your mortgage and you've gone through a substantial admin process to get your mortgage, that you're then under the cosh, under pressure to pay an arrangement fee again to see whether you get to extend your mortgage after you sell your house? You don't, and that's a key point. But I see the market, a lot of people say it's going online. I don't think it is, because we've had that for years, and there are certain things you buy online, like things on Amazon.co.uk or, you know, your Ocado delivery. But the end of the day is you need to have a relationship with someone that delivers, and that's what we do.
Great. Well, thanks for Coach Frank. I think that's probably any more questions?
No.
Perfect.
Great. Well, thank you very much for joining us, Matthew. And thanks,
Matthew.
Nick.
Thank you very much.
And thanks to all our listeners. Don't forget to like, subscribe, share, comment, and I will leave all of Matthew's details in the show notes. See you next time.
Thank you.
Bye.
Bye-bye.